You can see it, right?
Nope, I see you. But I'll get started with our intro. Hi, everyone. Thank you for joining us and for joining us a bit early as we are sort of figuring out some of the kinks here as well. We're going to be talking about the strategic investing using PAR. This is the most important topic of the series. We are doing a large case series, multiple webinars, and we're excited for that. This one is definitely the most important. This is the most common gap I see with advisors when they are starting to go after large case market, or even if they've been experienced in this market for a while and have missed some opportunities, gotten some opportunities, but this is where they often are falling down with their clients and with their prospects and losing the sales. So that's why I wanted to start here. We want to address this first because if the client doesn't understand or they're uncomfortable or they're not interested in the investment component of the power policies, a lot of the other strategies just won't really work for them. And that's what we see in the marketplace too. Many of you have probably talked to clients and prospects who have looked at these strategies. Some of the other strategies we'll be talking at later, and if you ask the client, why didn't you pull the trigger? Like, you looked at this, why didn't it make sense for you back then? And most of the times, the answer you're going to get back is going to be something along the investment component, or not understanding, or not comfortable with um, putting, in some cases, hundreds of thousands of dollars into a insurance policy. And usually that comes back to not understanding how the investment component works and why this is an investment strategy, not just buying insurance. So I brought on Weston Fader and Michael Dutra, the large case team here at Advisor Strategies, and we're really excited to start our presentation. And Michael, I'll hand it over to you. We do still see you though, so I need you to share your screen to get the presentation up.
It says shared on my side, so I can see it. And I think Marino says he can see the screen too. And same with Andrew. So I think
Okay,
everyone can.
well, I see you. All right, weird.
Okay.
All
Okay.
right,
Well,
I'll hand over to you then.
all right, sounds good. Very well said, Corey. So this is absolutely one of the biggest obstacles in kind of selling whole life or advising on it is the client understanding, is this an investment? Is this an asset? The word insurance kind of gets in the way. So me and Weston have put together some, I would say, kind of snack size bits of information to share with you to help you explain this to your client and help your client to understand to continue with the process. So I'll start off with some of the things that I tend to show when I'm describing whole life and more so the investment itself. So one of the things in particular, this is with Sun Life, and we'll show a variety of different companies, but every insurance company has a 20-page report, the annual par report that of course is very detailed, but it's not very helpful to just send that to a client for them to digest. Most advisors can't even understand it, so never mind sending it to a client. So I do like to kind of chunk it out in small kind of snack size bites, and this is one of the ways that I do it. So we look at the par, account dividend scale interest rate of Sun Life from 2007, and then comparing that to the 5-year GIC. Obviously, if you're showing this to a client, they can see the numbers are going to be much higher in the DSIR, but then showing that against the total TSX return. Now, after 3 are in front of you, there are a lot of numbers on here, but what I like to do is show, most importantly, the years the TSX was negative, and of course the DSIR is positive. So this really highlights the safety of it, the conservativeness of it. Can the TSX outperform in certain years? Absolutely. A whole life policy isn't designed to make 80% in a year or double or triple like crypto or something crazy like that. It's not designed for that. And personally, I'll say from my experience, when I tell clients that, it actually goes over well. They don't care that they're not going to double their money in a year from this. But I think they also care a lot about the years where the TSX or other indexes are greatly negative, and this is still spitting out a positive return. Uh, the other thing I always talk about, and hopefully you are familiar with this, but if not, the reason the insurance companies can pay out these steady returns is not because they make these steady returns every year. It's because they have something called smooth returns. So in the years they do very well, they don't just pay out everything the next year. They keep some in reserve, and that way they can have these steady returns. So again, when you explain that to a client, uh, least from my personal experience, they do seem to enjoy that smoothing factor, that reliability factor. It doesn't go up and down as crazy as the TSX, but it doesn't mean you can't have money in equities in TSX. Of course you can. Of course you should. Whole life should be a slice of the pie, but there's other things to invest in as well. But um, for me, showing this really does show the strength of it, where I mean, you literally can't, lose money like you can in the stock market. The other thing I like to show instead of year by year is the 5, 10, 25 year kind of average compared to the GIC and the TSX. And most importantly is the standard deviation. So to explain standard deviation to a client in simplest terms is really just how much it fluctuates year over year. So it's more stable than a GIC is, which is hard to believe but true. So this literally would stay more consistent year over year than a GIC, and most people think GICs are quote unquote the safest investment. And of course, the swing of the TSX is significantly more, but of course, with more risk comes more reward. So that's why you can make a lot more in the TSX. But both combined are a pretty strong, mix to have. Now, Canada Life, so Sun Life. So Canada Life, similar thing, 1, 5, 10, 20 year, etc. Comparing the standard deviation, it's going to be very similar amongst insurance companies. So there's, at least as far as I'm aware, there's not one insurance company that has, double the numbers or anything like that compared to the rest. But what I find interesting with Canada Life is, of course, they paid dividends since 1848, so almost at 177 years this year. And then a kind of a cool fact is the fact that they've been paying dividends before Canada became an official country. So they've never missed the longest standing, biggest par fund by far. It's like north of 50 billion now, I think. But again, the performance is very stable. Looking at this with Canada Life as well, like we show them dividends that have been paid for history and some of the worst crises, not just financially related, but massive, massive amounts and only increasing as the years go on, especially looking at 2020 and 2008. Like these companies paid out massive dividends to their policyholders, which of course is why it's called participating policies, because you're participating in the profits of the company. Vesting, hopefully you know this, but as soon as a dividend is paid out, it's immediately vested, which means the client owns it. The insurance company can never take it back. They can never decrease it unless it's at the owner's discretion. So the policyholders immediately own the dividends, which is, I find, again, a very attractive feature to talk about. It's like, getting a dividend basically, and there's no waiting period. It can't fluctuate. It can't go up and down year after year. So it's yours to own. And this is a Sun Life's portfolio. Every insurance company has something similar to this to really show you are invested indirectly into equity, real estate, private fixed income, etc. And you can get further tables breaking down the equities and the real estate holdings and government bonds, etc. If it's for the right type of client. Sometimes it might be too much information, but they do like to see kind of this level. Some want to go in much more detail. So there is definitely a more micro level of these investments depending on the client. I personally like to show things like this. Just these are some of the actual properties that are owned within these par funds. This is with Canada Life. Again, just showing that you really, your money is really being indirectly invested into all these things in this par fund, and it helps the clients wrap their head around that this is an investment, even though it's an insurance policy. That's really that one word I feel like is the biggest difference. But if you explain, options and futures and trading derivatives and all the different types of investing, there's so many types, but the underlying, like hopefully they're all assets, and they're all growing in the client's favor. So explaining this really does help get that message across to the client. This I find is a very, very important. This is taken from the Federal Income Tax Act under Section 148. So it literally has the word assets accumulated within a tax-exempt life insurance contract free of annual accrual taxation. So the word assets is in the Income Tax Act. Therefore, I mean, I don't know if it can be, it is an asset, and it does accumulate. And of course, you don't have to pay annual taxes. They do accrue free of annual accrual taxation. Now, as far as client goals, I find a lot of people who just want low volatility as part of their portfolio, but 100% they can still have equities. Like I've never personally advised a client to put all their money in whole life, and I don't know if there ever be a case for that necessarily, or it'd be rare. But absolutely, they should have their money in other things. If they want tax efficient growth, maybe dividends, maybe they have a dividend paying folio or interest income, or they have rental properties. They don't want to take out additional income and pay additional taxes in that year. This is certainly a good place to put their money to accumulate free of annual accrual taxation. They want tax efficient income, either to them or to themselves personally, especially if they have a lot of money in RSPs or a big pension. They're looking at alternative ways to access tax efficient money. This would be certainly one of them. And then, of course, to make sure their family and kids are left with something after all is said and done, whether that's before or after state taxes. And the last point, most people have no idea how state taxes or taxes owed in the estate, I should say, work. This is a great way to pay for those taxes owed in the estate, and mathematically, almost 10 out of 10 times, it is the most cost-effective way to do so. So, versus how to sell properties or use cash or liquidate investments to pay these tax bills, this is a fantastic way to do so. And I always kind of joke, but if this was called, estate tax insurance or something like that, more people would jump to it. But they hear life insurance and they think a little bit. You really have to break this down in variable several meetings to do, but hopefully some of these snippets would really just do in explaining that for clients. Weston, I'll pass it off to you, and you want me to stop sharing and you'll share.
Yeah, please. And I'll pull mine up. So, pardon me 1 second here, folks, while I just flip it over. And there we go. All right. Please let me know if that should be up and showing there, everyone. We're good. Awesome. Okay, and I'm just going to pause my video just to save a little bandwidth, and hopefully it comes through nice and clear. So thanks, Mike, for kind of laying out why PAR is such a stable asset and can be a really effective place to put money. So let's actually take a look at what that might look like for somebody who does that. So a really effective way I found to do this is positioning PAR as an alternative to bonds in a portfolio, and how that can potentially look. So again, as Mike had mentioned, he showed us Canada Life, he showed us Sun Life. I've got the Manulife PAR account here. So overall, they all show very, very similarly. So in any particular time, one company might be more aggressive in trying to get some market share and stuff like that. So in a shorter period of time, 5 years or 10 years, one company might look better than the other on some of these metrics, but by and large, they all respond generally the same way over time. So as you can see, low standard deviation versus the bonds, 1.6 versus 4.8. Which is about 67% lower, and over since 85, 30 plus years, it's about 62% lower, or about a third of what you would have on the bond side. And returns, since 95, the returns are about 20% higher than the bond, the comparative bond investment would be in that case. So that's pretty compelling right there. So when we actually put this into an illustration, what does that look like? And just so we're actually seeing real assumptions and not kind of pulling numbers out of the skies, because we know in the past it's easy to make any kind of an illustration, but we want to be as conservative and as realistic as possible. So this is done for a 55-year-old male, healthy non-smoker. He's got a current bond value in his portfolio of $500,000, and he's not anticipating making any additional deposits for the next 25 years. He's kind of got what he has, and he's happy with that amount. He's not looking to add much more to his retirement funds in that regard. The average management fees on a bond fund in Canada would be somewhere between 0.5 to 1% of the AUM. Again, these are pulled from the CSA and taxtips.ca, so you can verify those. In this scenario, I've made management fees are tax deductible, and I'm using the Alberta top marginal tax rate in this illustration. And then the other thing is, okay, well, what kind of returns are we going to be using? So you can pull up the Canadian financial planning guidelines. The 2024 gives us the different rates, and the one that we're most interested in is the fixed income. So 3.4 is what they recommend you use, and that is a gross return. That does not include, that's not net. So you still have to take off the management fees and administrative fees that may be associated with those investments. So 3.4 would be the gross return that we'll use. So here's a calculator that I like to pull up, and there obviously can be a lot of numbers showing here, but what I like to highlight is, what's our projected value of that 500,000 bond fund. So looking at this, we're over the next 25 years, it's currently at 500,000. We're generating a 3.4% rate of return over that time frame, and our management fees, I put it on the low end at 0.5, and it's tax deductible. Here is our total assets at the end of that 25 years, assuming you haven't taken any money out. It would be $725,000. Your earning rate is right there. The annual interest earned, the taxation you would expect on that, because we do have a 48% tax bracket as per the Alberta one. What you would expect for account management fees. So there's the amount that would be the asset value at the end of each year, but also what's available to the heirs or the beneficiaries at that point. So when we run all the way through that, your actual yield on assets over that 25 years is 1.5% per year, and it's the same for the heirs, because regardless at that point, it's still the same amount that's going to come out. So the question is can we improve these by just shifting dollars from say the bond investment into a different asset? So when we look at that, if we do a comparison, and what if we're transferring say $10,000 a year from that 500,000 into a life insurance policy that's built for that 55-year-old? So again, looking at this, all the same numbers, but we're just transferring 10,000 to a permanent life insurance. We improvement on your assets. It's a 41% improvement. We've gone to 2.12 over 1.5. So now you're over 2%, where before you're under 1.5. And again, these numbers are net now because we are accounting for taxes and administrative fees. In the case of the heirs, it increases to 2.6 because in the case of the person passing away, it's the death benefit that's going to go out to the beneficiaries at that point. So when we look at those numbers down here at the bottom, when we total them up, at the end of 25 years, the value of the asset where the bond was 725, we're now at 844,000 down there in the bottom right-hand corner. And next to that, we see 950,000. That's the death benefit that would be paid out if the person was to pass away at that time frame. So in both cases, just shifting, a relatively modest portion of that money into life insurance policy, and that's just for 10 years. So 10,000 over 10 years, $100,000. You're seeing, meaningful change in the value of what's going to be available for cash, but also what's available to the heirs. So what happens if we take this a little higher? If we go at 25. If we go to 25,000, we can see that in the top right-hand corner, the transfer to the PLI. And then that center column, 25,000, again, for just the 10 years. Our actual yield goes up to almost 3%, which is a 94%, almost 100% improvement from just using the bonds. And the actual yield to heirs is now at 3.86, 157% improvement. And the numbers again are along the bottom right. You're now over $1 million and almost at 1.3 for the heirs. So again, pretty meaningful change in assets for both the client for their personal use, and or if they're more interested in leaving this for their beneficiaries. So lastly is, okay, well, what if we try and maximize this as much as possible? So what if we look at saying doing 50,000 a year over 10 years? So as you can see at year 10 there down the left-hand column, we're now at 86,000, and then by year 11, you take out one more 50, you're at 37. We can tweak it a little bit more. I think it would be around 51 or 52. I just wanted to kind of keep it round numbers. But so this way, we're using the pretty much the whole bond fund, we're transferring it over time into the life insurance policy. So again, in doing that, what are the returns that we're seeing? The yield on the investment is now almost at 4%, or 165% improvement from 1.5 if you just kept the bonds as they were. The actual yield to the heirs is now over 5, going up to approaching 5.5. That's a 200 and almost 60% improvement on what you're going to leave for your beneficiaries at that point. And again, the actual numbers, we're now at 1.3 for asset value, and you're at 1.85 for from a life insurance standpoint of what's going to get paid out. And again, that's tax free at that stage. So, pretty compelling, where all you're doing is just moving the money from one asset to another. There's, there's no risk in doing that. We're not, as we can say, looking at the standard deviation, we're actually reducing risk over on the portfolio, but increasing the overall returns from both an asset standpoint and also proceeds to the heir. Oh, I missed a slide there. Give me 1 second and I'll pull it up. Well, I'm pulling up just the last slide there to say who would be a good fit for this. Is there any questions that anybody wants to throw in the chat there? Nothing yet.
No questions yet.
Okay,
But what software is that, or is that just a spreadsheet screenshot that you're pulling?
the calculator I had,
Yeah.
that is Truth Concepts. So that's a software that's based out of the US. I've been using them for about 12, 13 years now. I found it can be really effective with the right clients. There is a lot of numbers there, stuff like that. But again, depending upon who you're who you're talking to and stuff like that, some people really like that. So again, just kind of comes down to the individual client.
Yep. And it's definitely powerful when you're showing the bond fund that was going to increase to 750 grand versus having now 1.8 million. You added $1.1 million to that family's net worth.
Yeah. Oh, absolutely. And like I said, all you're doing is shifting basically the money from one pocket to another. So you're not going into anything crazy or adding a really off the wall strategy. These, as Mike showed, like Canada Life has been around 170 plus years. Manulife is over 90 years. Sun Life is 125 plus years, and they've all paid dividends consistently without missing a single year. So who is this a good fit for? So prospective clients. This is anybody that has substantial personal or corporate assets and are looking for a tax efficient way to grow it, because the money does grow tax free inside the policy, regardless of if it's owned personally or in a corporation. So if you see an account and they have excess money in a bank account, GIC, bonds, or any other interest bearing investments, it's probably worth the exercise to do a comparison of them. So hey, what if we take a portion of that money and we start flipping it into a par whole life policy for you? This is what it would look like for you personally, but also for your beneficiaries. Is that of interest to you? And a lot of people it is, right? Because you're enhancing what they already have and doing it for less risk. Business owners, again, are obviously a really good fit for this, from the standpoint that not only are you improving their asset value, but also it's a way to make sure that there's business continuity and provide for their families. And we'll go through that a little bit more in a future presentation. But how do your funding, buy-sell agreements, things like that, succession planning, maximizing your estates. This is an exact, a very direct way to show clients how to do that type of thing. Estate planners, clients that want to leave a good legacy, whether it's to their beneficiaries, to a charity, whatever it might be. This is a way to do that and minimize their estate taxes. Anybody who's risk averse, speaking to some of the advisors that might be out there in the exempt world, if you've been around a while, there can be clients that after being in high risk investments for a while, you know what? they've been stung one too many times. They do want something that's guaranteed, or they want something that's way more stable. This is often a really good thing to show them as a way to do that. Because again, once those returns happen each year, they're guaranteed and they cannot go backwards. It's contractually obligated that that's their cash value. So they really like that stability. And individual with long-term goals. At the end of the day, a par policy is something, the clients, the goal is they own that for life. So if they're, as Mike mentioned, if they're just looking for kind of a short-term, quick hit, quick growth type of opportunity, this is not the right fit for people. But for people that have a longer-term focus, this can be a really good solution for them as part of their overall plan. So again, what are their goals? Wealth accumulation. They want to build cash value over time with guaranteed returns and potential dividends. It's great for estate planning. If income replacement, and again, this will be a strategy that we go into more depth in a future presentation, but how do they access that money and use that in retirement really, really tax efficiently down the road? Business continuity, as I mentioned, and again, tax efficiency, again, being kind of an overarching theme, especially when you're talking about PAR, the tax deferral of the cash growth and the tax-free death benefit can be really, really appealing in a lot of situations for clients. So apologies for missing those slides last time, but there we go.
Thank you, Weston. Question came in. Do you present this when meeting the client's accountant?
Yeah, I can do that. What we would do, and Mike, you might want to, kind of do that as well, is what will often happen is, you'll present the strategy or an idea initially to the client, and if they have some interest, then we typically want to bring in an accountant or any other advisor that they use to help them with their financial decisions, if that's not just you yourself. And yeah, those can be really effective with accountants that again are more number oriented, if you will. So happy to pull those presentations up and walk an accountant and the client through that if we think that that's going to be a good fit to help advance the case and get it across the finish line for you.
Yep. And there can be age restrictions, but more often it's not actually the maximum age of the policy. It's actually the client's health that can be a challenge. When do you kind of see as the age where you really have a harder time getting these things approved?
It's health over age, I would say. Like I've had people in their 30s can't get it, and people in their 70s done big policies for. For me personally, it's health over age.
Yeah, that's 100%. The other thing to consider in the right situation, the policy doesn't always need to be on the person, on the owner of the policy or the person that is paying for it. You can set these up where, as long as you can show an insurable interest, the policy is on children, it's on other family members, it's on a business partner. As long as you can show that there's an insurable interest, you can put these policies in place, and as long as you or your business remains the owner of the policy, you remain in control of it. You control the cash values and all that kind of aspect. So just because somebody is maybe not super healthy or maybe a question mark of getting the policy, it doesn't mean that kills the strategy outright. It just means we have to do a little more a little more discovery potentially to see if it's a fit.
Yeah, there's a lot of different ways to do this. All right. Well, thank you very much, Weston and Michael, for presenting. I would say that this, as I said, this was the most important presentation we were doing, but it's very often a precursor to many of the other strategies. So if you are going to be leveraging whole life or doing some of the corporate strategies or presenting many of the other topics we're going to be going through in the future webinars, often advisors should be presenting like PAR as an asset class first, presenting this strategy, presenting why it makes sense to invest in this before you dive into sort of the next stages of that, of some extra tax opportunities or how you're pulling out the cash or what this means for your estate. A lot of that stuff should come after presenting this as an investment strategy to make sure that the client understands this is an investment that they should have or potentially should have in their portfolio that could be a really good fit. that it has some investment advantages around tax, around smooth returns, around the vesting of the dividends and the cash value. It is a very strong investment strategy on its own. And then when you layer in the other strategies, the tax, the charitable giving, whatever it is, it just becomes that much more powerful. But if you don't get this point across at the beginning, it can be a lot harder to sort of go back to it later if they've sort of not seen it as a great investment strategy. And investors today, like, there's a lot of volatility in the markets. There's a lot of uncertainty right now. I mean, we might be going into a trade war with our biggest trading partner. Weston mentioned his software is out of the States, and my first reaction was, well, you better cancel that. You know, Sport Canada, we got to find another alternative here. But yes, there's a lot of uncertainty, and investors are looking for investments that have a little bit more have a little bit more safety, a little bit less volatility. They don't want to be losing sleep because they're not sure what's going to be coming next in the next news cycle, or what can change with their investments. And when you're planning for retirement, have a long-term outlook, your estate, you don't want to be risking that on what happens in the news over the next few weeks. You want a long-term strategy, and this is a really great fit for that. And we see a lot of investors and advisors utilizing this strategy quite often. So I just wanted to highlight that. This is definitely our first presentation, or our most important presentation here. And if you have any questions, Weston and Michael are available. They are part of the large case team. They are here to support you. If you have any client opportunities, they're your go-tos. And I appreciate you guys joining me today.
Corey, what's going to be the next presentation?
Good question. I don't have my schedule in front of me. Do we?
Oh, we put you on the
Next, no. Next Tuesday, same time. 18th.
What's the topic though?
Oh, on I have corporate insurance as the title.
Yeah.
Strategy, yeah, for strategies, yep. Corporate insurance.
So we'll be going into corporate strategies next. We have two presentations on corporate strategies, because it is two that we had to. It is a topic we had to break up, and lots of stuff to go through. And a lot of the corporate strategies utilize PAR as an investment strategy. It's the underlying precursor. And yes, that is a lightsaber in my background. I get that question quite a bit, but yes, and a gaming chair. I don't hide those parts of my personality. I'm a bit of a nerd, but in this case, I'm a finance nerd. So we're talking about investment strategy, which I love as a topic. All right. Well, thank you very much for joining us today, and we'll see everybody at the next presentation next week.
Sounds great. Thanks, everyone.
Thanks.